All right, the bell rang 15 minutes ago. Let's get right to the damage.
Let's do it.
The S&P 500 closed at 6,932. That's down 0.54%. The Nasdaq Composite shed about 0.35%. And the Dow Jones Industrial Average is down 0.28%.
All in the red.
All in the red. We did see energy lead the board, though, up 1.4% on those geopolitical supply concerns we've been tracking.
Right.
Meanwhile, consumer discretionary, it just dragged the rear, down 1.1% as that retail data continues to cool off.
And, we need to be really clear about what we just watched. That session was a choppy mess.
Zero conviction.
Absolutely zero conviction. It was all defined by end-of-month rebalancing. That whole January effect that everyone was so excited about, it just hit a brick wall today. I mean, we touched that psychological 7,000 level earlier in the month, but today was a hard defensive pivot.
And the volume just confirms that lack of conviction, doesn't it? We're looking at, 869.7 million shares on the tape?
Right, against a much higher average.
Yeah, it gets a 30-day average of 921.3 million. So this wasn't capitulation. It wasn't a panic sell-off.
No.
This was just a wait-and-see retreat.
It's a retreat, you're right, but the context here is so critical. The market is trying to figure out if the party is over or if we're just, taking a quick breather. But you look at the flows, and it tells a very specific story.
Okay, so let's get into that narrative, because on the surface, a 0.5% drop isn't a total disaster. But the why behind this fade, it seems to be catching a lot of desks off guard. We have to talk about the catalyst.
The elephant in the room.
The nomination of Kevin Warsh for Fed chair.
This is it. This is the headline risk that just became a reality. The market was positioned for continuity, right? Or at least a predictable, dovish path.
Sure.
The Warsh nomination is a shock to the system. It really represents a regime shift. And you have to understand, the big institutional desks, they view Warsh as a hawk. He prioritizes inflation control over liquidity.
And liquidity has been the drug of choice for this entire rally.
Precisely. It's the only thing that's mattered. So if you put a hawk in that big chair, you are effectively repricing the 2026 terminal rate instantly.
Wow.
Market is waking up to the idea that the easy money era might be getting a very hard stop. And that's why we saw what we call a beta reducing wave today.
Okay, let's unpack that for a second. Beta reducing.
Right.
We're essentially talking about institutions shedding volatility, right?
Right, exactly. Beta is just a measure of how much a stock moves relative to the market. So high beta means high risk, high reward. Think your speculative tech, biotech, crypto.
Yeah.
And low beta is your boring stuff. Utilities, consumer staples, telecom. So today, the institutions sold the high beta and they bought the low beta. They're just reducing the overall volatility in their portfolios.
Which explains exactly where the money went. Because it didn't just disappear into cash, not entirely. We saw a very distinct rotation.
A very sharp rotation.
Institutions faded the rally and all the high flyers. They moved capital from large cap tech right into defensives. We're looking at Verizon up 6.6% today.
A monster move for a name like that.
And healthcare caught a serious bid.
That is the textbook definition of smart money behavior. They used that early week momentum, the lingering excitement from that 7,000 touch, to exit their high beta positions.
They sold them to latecomers?
They handed the bag to retail and rotated into safety. I mean, Verizon up almost 7% on a day the S&P is down. That is not an accident. That is a flight to quality and yield.
It's basically big investors saying, you know what, I don't care about growth right now, just pay me my dividend and please don't lose my principal.
That's it. It's defensive positioning 101.
And while the smart money was piling into Verizon, retail was apparently trying to catch a falling knife in the commodities market.
Oh, that was brutal.
We really need to do a deep dive here because the moves in precious metals were just violent.
Violent is the only word for it. This wasn't a dip. This was a liquidation event.
Let's look at the tape on this. Gold opened near a lifetime high of $5,600 an ounce. It then cascaded through the whole session to close near $5,100.
Think about that.
That's an 8% intraday reversal. In gold, an asset that's supposed to be stable.
An 8% move in gold is like seeing the VIX go to 80. I mean, it is just unheard of in a normal session.
And silver was somehow even worse. It hit 120 early in the session and then just collapsed 15% to close sub 100.
So what we saw there was a classic gamma squeeze exhaustion.
Okay.
You had everyone, and I mean everyone, piled into the long side. The trade was just too crowded. And when the momentum stalled, even for a second, the exit doors were just way too small. Long-term bulls took profits, and that triggered an absolute cascade.
Can you explain that gamma squeeze mechanic a bit more? I mean, we hear the term all the time, but how does it actually trigger a crash like we saw today?
Sure, so think of it like this. When everyone is buying call options, betting the price goes up, the market makers on the other side of that trade, they have to buy the underlying asset, in this case gold, to hedge themselves.
Okay, so it creates a feedback loop.
It creates a perfect feedback loop. People buy calls, so market makers have to buy gold, which makes the price go up, which makes more people buy calls. That's the squeeze on the way up.
The elevator up.
Right. But when the music stops, and maybe it stopped today because of the Warsh news strengthening the dollar well, those market makers suddenly have to sell all that gold to unhedge themselves. And because everyone was on the same side of the boat, the selling just triggers more selling.
A vacuum.
It's a vacuum. The liquidity vanishes and the price just free falls until it finally finds a buyer willing to step in.
It really felt like a forced liquidation.
It was. This wasn't a dip to buy. This was billions of dollars in paper wealth just being erased in under 2 hours. And it connects right back to the macro picture we were just talking about. This gold fever, this idea that the dollar is dead and commodities are the only play, it hit a wall of reality. With Warsh potentially coming in, the dollar might actually strengthen. Cash is becoming a tactical weapon again.
Cash is not trash anymore.
It's not trash anymore.
That is a key takeaway for everyone listening. Cash is a position. Okay, but let's pivot to the other side of the market. We talked about the rotation out of tech, but it wasn't a uniform sell-off. We are seeing a massive divergence in the Magnificent Seven.
This is probably the most important theme for active traders right now. The Mag 7 is dead as a monolith. You cannot just buy the basket anymore and expect it to work.
So it's a quality filter market.
It is absolutely a quality filter market. The street is picking winners and losers within the sector, and it's based on one thing: capex versus return.
Let's talk about the losers first, because the reaction to these capex fears is just brutal. I mean, Microsoft continues to slide. They dropped 10% yesterday. And today, every single intraday bounce attempt was just swiftly sold off.
Yeah, the market is punishing what it sees as blind AI spend. Microsoft is pouring billions and billions into infrastructure. But the cloud drag is hurting margins, and the street is asking, okay, but where's the immediate profit?
Right.
And when they don't see it, they punish the stock. It is a show me the money market, plain and simple.
And then you look at Apple. I mean, they actually beat revenue by 16%. In any other market, that stock gaps up and runs.
It should have been up 5%, easily.
And today, it closed down roughly 0.3% at 257.52.
That right there, that is the scariest signal for a bull. When a behemoth like Apple beats expectations that significantly and still can't hold a rally, that tells you the trend is just exhausted. The market is demanding perfection, not just good. And those AI capex fears are bleeding over to Apple, too. Investors are worried about the cost of this next innovation cycle.
But then you have the outlier,
Correct.
The winner of the day. Meta Platforms.
The outlier indeed, the one bright spot.
Meta is up 10% on massive volume.
And here's the difference. Meta announced a $115 billion plus capex plan. I mean, huge numbers. But the stock rallied. Why?
The ROI is visible.
Because the ROI, the return on investment, is visible immediately in their ad revenue numbers. The market blessed their spending because they prove they can monetize it right now.
So the trade implication here seems pretty clear. It's an asymmetric setup.
It is. The trade is long Meta, short Microsoft. Or short some of those SaaS laggards like SAP or ServiceNow. Capital is rotating internally. It's not leaving the tech sector entirely, but it is ruthlessly moving from the promise of AI to the profit of AI.
A quality filter. Okay, let's look under the hood at the market internals. We mentioned the volume was light, but the breadth. The breadth tells an even darker story.
The breadth is where all the cracks are visible. The advance decline ratio was negative, approximately 1 to 2.
So for every stock that went up, 2 went down.
Exactly.
And the small caps, the Russell 2000, they just completely stalled out.
And that's the problem. Earlier in January, we had this rising tide narrative where everything was going up. That is gone. We made an all-time high on the S&P this month. We hit 7,002.58.
Yep.
But the participation is bleeding out. It's a major divergence. The generals, the big safe names, they're holding up the index, but the troops are retreating.
Let's check the fear gauge. The VIX closed at 17.08, up 1.2%.
And it spiked all the way to 19 this morning.
Right. It didn't stay there, but it didn't crush back down to 12 either.
No, this wasn't a volatility crush. This
Yeah.
was a defensive bid. We are seeing the VIX leave that complacent sub-15 zone. And when the VIX starts establishing a floor around 17 or 18, it means traders are buying protection. They're paying up for insurance.
So they don't trust the weekend.
They do not trust this weekend.
So we have a fragmented rally, a rising VIX, and a hawk nominated for the Fed. That brings us to Monday. What is the setup? Because we are sitting at a very, very precarious level.
We are staring at a gamma wall.
And the key level there is SPY 690, or for the index, SPX 6,900.
That is the line in the sand. Mechanically, 691.50 is the real pivot. But if 690 breaks, we enter what's called negative gamma.
Explain that for the listeners who don't trade derivatives. What does that mean in simple terms?
Okay, so when we go into negative gamma, the market makers, the people who provide all the liquidity, they are forced to sell into weakness to hedge their books.
So it accelerates the selling.
It's an accelerant. If the market drops, they have to sell more, which makes the market drop faster. If 690 breaks, you could see a flush down to 686.25 very, very quickly.
And if a 690 holds?
Then we're likely to see a pin or just a chop session. We'll bounce around while the market digests the Apple and Amazon earnings from last night.
Looking at specific tickers for Monday, we have some day 2 plays setting up based on today's action. Let's start with the strong one, Meta.
Yeah, Meta's the strongest chart on the board, but you don't chase it at the open on Monday. You have to look for a retest of that breakout base. I'd watch the 730 to 735 level. If it holds there, you can enter for a potential move to 750.
And on the short side, Microsoft.
Microsoft is on death watch. You watch for a washout trade under Thursday's low. If buyers don't step in immediately and defend that level, it's going to be a liquidation tail. Any bounce up to 420 or 425 is likely a shorting opportunity.
So it's going to be a very technical trading environment, but we also have a huge macro catalyst looming. Monday brings the ISM data.
And that's the reality check. We have been trading on this soft landing narrative for months now. Monday's data will tell us if that is fact or fiction.
Right.
If the economy is cooling too fast and we have a hawkish Fed nominee coming in, that 690 level is going to be tested and tested hard.
It really feels like the easy mode of January is officially over.
Oh, it absolutely is. The Warsh era is being priced in, but the digestion period, it is not over. We are in a new regime.
So the strategy for the weekend?
Don't chase the all-time high. It feels like a trap right now. Wait for the levels to confirm direction.
And as we said, cash is no longer trash.
It's a tactical weapon for February.
Stick to the levels.
Watch the bell. We'll see you Monday.